Meantime, JOLTS job openings coming in lower than estimates, just below 7.2 million versus 7.4 million expected. Joining us to discuss is Joe Lavorgna, counselor to the Treasury Secretary, Scott Bessent. It's good to have you, Joe. Welcome back.
Thank you. Thank you, Sarah.
So is this just more evidence that labor market is cooling?
It's cooling a little bit, Sarah, but if you look at the current rate, it's exactly where it was in the fourth quarter of 2019. When the Trump economy generated nearly 3.5% real GDP growth. And the most important thing, Sarah, is the one big beautiful bill, which is a huge middle and lower income tax cut, is in place. And the forward, meaning future economic activity and growth prospects, look fantastic.
Why? What is the bill? When is it going to filter into the real economy, and what's going to be the impact?
So right now, Sarah, it's already filtering in. If you look at capital spending, it grew over 15% in the first half of the year. The AI story is certainly very powerful, but we saw good growth in industrial equipment, transportation, and that was the result of the fact that the bill was written to make capital spending retroactive to Inauguration Day. So that spending has accelerated. We saw the new orders component in the ISM the other day improve, and it looks like, Sarah, right now, the widely followed Atlanta Fed GDP is forecasting 3.5% GDP growth, and that's after a 3% plus gain in the last quarter. So the trajectory of growth is very solid.
No, it's good. It's good to see capital spending growth, and I know that was one of the aims of the bill. But then why aren't companies more confident about hiring right now?
Well, a lot of the slowdown, Sarah, was related to what I'd call a sugar high on the prior administration just massively lifting fiscal spending and creating artificial demand and therefore engendering faster inflation. What we know historically is when capital spending trends improve, hiring inevitably follows. You also see it in the GDP data. You've got very high corporate profits. You've gotten very good margins on the retail sector. That should push back against this narrative that somehow tariffs have been inflationary. And therefore, this capital spending comeback, as we like to call it, is a very positive sign for future hiring. That means in the months and quarters ahead.
So does it mean that the Fed shouldn't get that aggressive with rate cuts?
No, because the economy, if it wants to get its full potential, you'd argue it would need rates in line with what are considered neutral. And by even the highest dot on the Fed dot plot or histogram, rates are restrictive, and Chair Powell himself has admitted as much. And one of the areas of the economy that has been weak are the interest-sensitive sectors, and that's largely an interest rate story.
Joe, the Secretary, Bessent, posted last night, I think, on X. He was talking about tariff revenue. He thought the total could reach $300 billion this year, but it could be much higher. This is from his interview on Fox. And then he wrote, every $300 billion adds 1% to GDP. With tariffs alone, growth could hit 5%. Do we have that right?
Yeah, I didn't see the exact comment, but what the Secretary's highlighting, Carl, is the fact that the revenues from tariffs have been extraordinary. We're actually running above a $300 billion annualized rate. The Secretary said we may even hit 500 as this trend continues. And what the revenues do is they'll lower interest rates and they'll galvanize very fast growth. 5% growth would be great, but we're looking at growth we think that's sustainably at 3% plus. That's basically what we saw in the first Trump administration, and what we saw, Carl, as you remember, was strong growth and low and stable inflation. And by the way, back then, interest rates were a good deal lower.
Right. So these kinds of scenarios are contingent on what level of interest rates, do you think, over the longer term?
Well, the central tendency of the FOMC's forecast is about 3%, 275 to 3%, maybe a shade higher. That's about 150 basis points or so higher than where rates are now. And you've heard various Fed governors, such as Governor Bowman and Governor Waller, talk about the need to adjust rates. It does look like the chair, based on public comments, is going to lower rates this month, so we'll see what happens.
Are you part of these interviews that the Treasury Secretary is doing?
No, I mean, I help the Secretary in whatever he needs as it relates to macro issues. That process, Sarah, will begin soon, as he said. And if I'm asked to help in any way, absolutely, but this is the Secretary's mandate.
What do you want to see in the next Fed chair?
What I'd like to see is really a wholesale reevaluation of how the forecast process is done. So this is changing the Division of Monetary Affairs, changing the Division of Research and Statistics to have less groupthink and to have more robust macroeconomic discussions. It's not as if the economics profession has a uniform consensus view of the world. They're known to disagree. So I would like more debate at the governors to get more varied viewpoints, not have a similar type of view, which is basically a Keynesian stochastic dynamic equilibrium model of how the world works. It doesn't work that way in principle. And really kind of changing it from the bottom up. And of course, as the Secretary has mentioned, Sarah, having much less mission creep, focus on macroeconomics, not climate change, not issues of equality. Those microeconomic issues really don't have any place in central bank decision making.
To be fair, they haven't really done that.
No, they have. If you look at a lot of the research, but especially the various reserve banks, and to some extent the board, they've definitely gone way past what their mandate is.
But not in setting policy. Finally, I just want to ask you, Joe, on tariffs. The Treasury Secretary said if the Supreme Court does not uphold the tariffs, there are other options, and I'm wondering what those options are, what the Plan B looks like here.
Well, first and foremost, the President and the Secretary believe that the courts will rule in favor of these options. The President has the ability and authority to implement these tariffs. That's number one. Number two, one of the options the Secretary has mentioned, should it come to that, and we don't think it will, would be Section 338, which was part of Smoot-Hawley. But again, we're hopeful that will not happen, and we look for a speedy resolution to this issue.
Evercore's out today, Joe. They write, if the court does rule against the use of IEEPA for tariffs, it could constrain the freewheeling use of tariffs as a political tool, which they think would be growth positive because tariffs would be more predictable, less volatile. What's wrong with that argument?
Well, first of all, there's other tariffs. It's not just IEEPA, there's also Section 232. But again, the notion, Carl, that these tariffs are somehow cause all this extraordinary uncertainty. I mean, there was some uncertainty in April, no question. That was part of the leverage and the negotiating strategy of the President and the Treasury Secretary. We had the fastest, biggest move off of a 15% equity correction in the market's history. Markets are forward-looking. Markets are discounting the fast growth we've seen. I don't understand why people are talking about this uncertainty hurting everything. You don't see it in the data. Tariffs, you look at goods prices within the CPI, they're up 0.7 annualized since we started to take in record tariff collection in April. So I just don't buy into this uncertainty argument. I think it's an excuse, and hopefully it eventually will go away.
Joe Lavorgna, thank you for joining us and shedding some light on the administration's thinking around some of these numbers. Joe Lavorgna from the Treasury.